Exchange-traded funds, ETFs, are investment vehicles that hold portfolios designed to track a specified index, asset class, or investment strategy while trading continuously on secondary markets like common stocks. ETFs combine characteristics of mutual funds and individual securities, offering diversification, liquidity, and transparency. Most ETFs invest directly in underlying securities, although some utilize derivatives, leverage, or depository receipts to achieve their objectives. Unlike traditional mutual funds, ETF investors trade shares with one another on exchanges rather than directly with the fund sponsor. This structure enhances market liquidity and operational efficiency while allowing investors to gain broad market exposure through a single tradable instrument. A key feature of ETF operations is the creation and redemption process facilitated by authorized participants, APs. Authorized participants are large financial institutions that can exchange baskets of underlying securities for ETF shares or redeem ETF shares for the underlying securities. When ETF demand rises, APs create new shares by delivering a creation basket to the ETF manager. Conversely, when demand declines, APs redeem ETF shares and receive a redemption basket. Because these transactions occur in kind rather than through cash purchases and sales, the process minimizes transaction costs and tax consequences for existing shareholders. It also helps maintain ETF prices close to their net asset values, NAVs. Tracking error is one of the most important performance measures for ETFs. It represents the annualized standard deviation of the difference between ETF returns and benchmark returns. Ideally, an ETF should closely replicate its benchmark, but various factors can cause deviations. Sources of tracking error include management fees, operating expenses, sampling techniques, optimization methods, regulatory restrictions, taxation, and portfolio rebalancing activities. ETFs that use depository receipts instead of directly holding underlying securities may also experience greater tracking differences. Because investors often choose ETFs for benchmark exposure, minimizing tracking error is essential for maintaining the intended risk-return characteristics of the investment strategy. ETF trading costs are influenced by bid-ask spreads, which represent the difference between the price at which investors can buy and sell ETF shares. ETF spreads depend on several factors, including the liquidity of underlying securities, creation and redemption costs, market-making risks, and the expected profitability of authorized participants. More liquid underlying assets generally result in narrower spreads because market makers can hedge positions more efficiently. Conversely, ETFs holding less liquid securities tend to have wider spreads. The probability of completing offsetting trades in secondary markets also affects spreads. Investors should therefore consider spread costs in addition to management fees when evaluating ETF investment opportunities. Although ETF prices are generally close to net asset value, temporary premiums and discounts can occur. An ETF trades at a premium when its market price exceeds NAV and at a discount when its market price falls below NAV. These pricing differences often result from timing mismatches between ETF trading hours and the trading hours of underlying securities, particularly for international ETFs. Stale pricing of infrequently traded securities may also contribute to apparent premiums or discounts. The creation and redemption mechanism typically limits persistent deviations because authorized participants can exploit arbitrage opportunities, thereby helping restore alignment between market prices and underlying asset values. ETF investors face several categories of risk that should be carefully evaluated before investing. Counterparty risk is particularly relevant for exchange-traded notes and derivative-based ETFs because performance depends on the financial strength of counterparties. Fund closure risk arises when an ETF fails to attract sufficient assets and is liquidated, potentially creating unexpected tax consequences and reinvestment challenges. Expectation-related risk occurs when investors misunderstand how specialized ETFs operate, especially leveraged, inverse, or complex strategy-based products. These products may perform differently from investor expectations over extended holding periods. Understanding ETF structure and objectives is therefore essential for effective risk management and informed investment decision-making. ETFs play an important role in efficient portfolio management because they provide flexible and cost-effective access to diverse asset classes. Portfolio managers frequently use ETFs for liquidity management, temporary cash equitization, portfolio rebalancing, and transition management during investment strategy changes. ETFs can also provide exposure to broad asset classes, specific sectors, geographic regions, or investment styles. Their intraday tradability enables rapid implementation of tactical asset allocation decisions. Compared with purchasing numerous individual securities, ETFs offer operational simplicity and diversification benefits, making them valuable tools for both institutional and individual investors seeking efficient portfolio construction and management solutions. Beyond passive index tracking, ETFs increasingly support active investment strategies. Smart beta ETFs seek to outperform traditional capitalization-weighted benchmarks by emphasizing factors such as value, quality, momentum, or low volatility. Alternatively weighted ETFs and actively managed ETFs provide additional opportunities for investors seeking enhanced returns or improved risk management. ETFs are also widely used in dynamic asset allocation strategies that adjust exposures based on changing market conditions. Their transparency, liquidity, and relatively low costs make them attractive vehicles for implementing both strategic and tactical investment decisions. Consequently, ETFs have become indispensable tools in modern portfolio management and investment practice.